Yeah, man. But like
What else did
those calls at like 3 o'clock in the morning, you sleeping with your iPad, and I was just saying to Eddie, like Neelesh and I are so old, we just used to use Skype. They don't have Skype anymore. But Nick's
I remember that. The Skype
it's
doesn't
true.
exist anymore. I can't
This
believe
guy
that.
doesn't exist anymore. But when I remember Nick, when one time I said, "Hey man, your Skype is really powerful," and he said to me, "Hey man, no jokes. My Skype account is worth $1 million," and I was like, "Yeah, that shit's not wrong."
Yeah. Oh,
Oh, hey Sri.
Love the glasses, Rene. What's going on there?
It's blue light blocking glasses. I've got I'm working
I was
too
just
many hours.
trying that same thing out. I think my spectacles did the exact same thing. Probably I got to get your Tony Stark
Dude,
glasses as well. Probably.
Tony Stark. I got the idea from Eddie. He told me to do it, but I've got a big strobe light here, and I got lights over here, and I got these lights and background. And it's just like, oh man, my circadian rhythm's all messed up. It thinks it's like the middle of the morning.
Straight out, everything straight out. Hey Ed, hey Nick. I don't think we've met, but good to see you, sir.
So Nick is here to say hi to Neelesh.
yes,
Just
yes.
here to say hi to Nick. Yeah,
absolutely.
to
And I am here,
yeah.
and I
I
am
have
here
to
to say
say,
hi to my old friend Nick. Although
Ah,
you
come
can't
on,
see me,
bro.
I mean,
You
oh,
can't
look
see
at
you.
what?
you.
Oh, what do I do? How do I make myself visible? Look, wait, let me try.
Fully camouflaged there, bro, in the dark.
Yeah.
Look at that
You should
sunset.
get
I don't-
you should get Mahi to like, hit some flashlight on you or something like
Yeah,
that. He has
he's on
another
the other
colleague
call
with him.
actually. He's on other
Oh yeah,
call.
yeah,
He's on that call with the auditors. Can you
Yeah,
make some sense of it, Nick? Can
it's
you?
I'm gonna tell you, just hearing your voice gives me chills. I remember when he first
I
started at EVI. I remember
Yeah.
him, going through the cadence and the motions, and now, it's over 10 years, probably over 15 years later. And
50.
to watch the evolution of not only you, but also Rene. I remember when Rene started and was, the new guy at First Climate, and makes me feel a little old, but a little humbled. You know what I mean? And
Yeah.
I have chills all over my body right now because I am very how this market is evolving. In the beginning it was CDM, and then Vera first started, and we issued 10 million tons one year, and everybody thought that was a lot. And they got up to, so many millions per month, and all the business we've done. And now to see you go into biochar, I have to say, I don't know about what you've heard, but I've taken a big step back. Rene, I'm just riding Rene's coattails on this new thing
No,
of
he's not.
Altera, and watching Eddie evolve and watching the young guys, evolve. But I will say this, we've noticed a transition from going from the solar, the wind in, China and India, which was our biggest sellers at that time, to now the more exclusive stuff, which, Eddie is actually becoming an expert on, which is the biochar, which is the Aflu projects and whatever. And this is where we see the market. I see the market moving to a much higher quality piece for the volume in dollars and the business we need to be a sustainable business. And to see you transition to that without, just like you doing it, makes me feel
Yeah.
so good, because I know it might not feel like it right now. But what I tell people when I go into business with them, the first 1 or 2 years are a little challenging. Stay focused, never
Yeah.
give up. And I'm telling you, I truly believe you are on the right path, your whole team, in going into this direction. And even though I really don't, you could, there's no more Skype anymore, but you could definitely what's up,
Talking about
what's
Skype.
WhatsApp me. I'm on WhatsApp now. But if you have a question and you're like, hey, how does this look? The one thing I can provide to you is honest feedback, right? Love me or hate me, it's honest feedback. And I want to stay on, but I am in Florida now, and I'm sort of on a mini vacation with my wife, and I got to jump off. But I just wanted to congratulate you and to tell you that
Thanks, man.
I am very proud of how you evolved, and I like the direction you're going in this business. And I do believe you definitely maintaining a relationship, your team maintaining a relationship with the Valaterra team is a good thing. And I'm not saying it because, like, I'm one of the founders of. That's not the truth. The truth is the reason why is because Valaterra, as a sales team, as a marketing team, there is pretty much, I don't think right now, none better, which, I want somebody else to raise the ball, but it's very hard to catch Rene with his marketing genius. And then as far as the sales guy go, we have, Vincent, Matt, Cooper, Eddie, and, that team is very sharper than I ever was, and they're doing a great job. So with that, I wanted to say, great seeing you guys. Keep focused. Be
Yep.
consistent.
Thanks, Nick.
And
That's
I'll let
great.
you guys
Before you drop
go
out,
and have a great
now before
time
you
on this podcast and rock the house. Okay, guys?
Nick,
I'm
Rock and roll.
united, man.
just
And
hold on for a second,
Neelesh,
Nick.
next time.
Just hold on for a second, Nick.
Hold on for a
Just
second, Nick.
hold on. Just at least for a couple of minutes. I'm gonna
5
log off after
minutes.
that as
5
well.
minutes.
Because I mean, now that you have said and you have reminded me of the chills, I definitely need to tell one incident, I think, which I think is definitely something that I still feel, and whenever I feel it gives me chills. So, of course, Nick was the point person for anything in the market at APX, and me at EVI trading stuff, and cocky as usual. Usually used to think that I'm gonna sell quite a lot. There was this once auction that we had to do, and it was at Climax. You guys wouldn't know, but there was this entity called Climax. So it was late at night, and I was so sure of winning it because previous 3, I think we won 2, that I messaged Nick that before I'm sleeping, I messaged Nick on Skype, said that this is what I have initiated the transfer already. I'm going to win this. You transfer it. In the morning, we'll see. And late night, last 2 seconds, being cocky as usual, I submit my bid and it doesn't go through. It doesn't go through. Now I'm stuck. Now I'm asked Nick to already transfer it. Now I'm shitting in my pants thinking if Nick has already transferred, this has gone $1 million worth of credits is already gone. Where am I going to go? But luckily, Skype, that's why I still remember Skype. Skype was there. I immediately jumped onto it, and Nick, as usual, was prompt enough to stop that. But yeah, those were the days wherein we were literally just swapping around. We were doing good stuff. I mean, I still remember that. But yeah, I mean, these were the instances that really stood apart because of the kind of responsiveness and kind of relationship me and Nick and Rene we had. I think we were there for each other at that time. And
Yeah,
honestly
man.
speaking, Nick, I've seen you transition into real estate, but I'm telling you, this is far more interesting. I have made that transition. I think I'm enjoying it. At least I'm on the site. I'm enjoying it. So so far so good. As long as it is enjoyable, I think I'm gonna do it and keep wishing my partners here, Sid and Shri, they are the perfect alias for me to be able to do this because they bring that energy, they bring that charisma. I can only do something on the ground, something here and there, but these guys have to carry it forward, and I'm sure they will. But yeah, here, thanks so much, Nick. I heard that you never come on these. Same here, but appreciate you taking that time in your vacations to come. Really good seeing you, mate. Let's catch up soon.
Yeah, I'll just leave one piece when he mentioned items like what he did. So, I was the administrator, and once you do a transfer, and it's accepted, you can't take it back unless I do some stuff behind the scenes, right? And I always protected the project developers because there were a lot of funny guys in the business that would, take the credits and then you'd have to beg to get them back or whatever. And then I created the escrow service, which later sort of evolved into EMA, so to speak, right? Because before you just transfer and it was done. Now, at least with, CBL, you could transfer it and the people, when they accept it, they got to pay for it. There's certain things that are better. But all of these events helped, like what we did with Neelesh, all these things helped evolve the market to where it is. So when you look at EMA and you see some of the things, some of the reasons why they are there is because of trades like I did with Neelesh, where I had to we got to fix this. But anyway, listen, guys, have a great time. Enjoy.
Nick, I had one question for you. One question, and then we'll leave you. I'm sorry, but I had to ask you this, right? You guys have been in the market for 15 plus years, right? And obviously the market is at a crossroads. Sorry, Rene, I have to, I get called this a lot, age shaming. Whenever I tell Nilesh that you're 15 plus years in the market, I get criticized that I age shame. And it's nothing to do with age shaming, honestly, but you know, the experience and the wisdom that you guys bring to this market, that's what really honestly attracted us to Nilesh as well. Because when we started off, we were just, you know, people who understood the capital stack, people who understood technology, but we didn't understand carbon very deeply, right? And to find Nilesh, and kudos to him, like you said, to bring in that energy to like help transform this market, right? We're very, very grateful that he took a bet on us as much as we took a bet on him as well. But personally speaking, and I want the world to know this as well, and if we can bridge this in the podcast somehow, it would be great. But the question that I have for you is, you know, you've been in the market for so long, right? And the market is at the crossroads today, right? It's very clear, like you mentioned, that, you know, we're moving towards AFOLU based removals, we're moving towards biochar based removals, right? Where do you see the market play, and how do you see that market sort of evolve, right? And if you had a crystal ball, and you had to share your opinions, where and how do you think it's going to play out? Very curious to hear you.
Okay, so I've been very lucky in calling this market, and there's a lot of factors in play. As this market gets bigger, more factors affect it, right? So this market will always be in some sort of transition because it's a new market. It's really only 20 years old. If you had to really say how old it is, maybe 25. I felt that, and I told the team that 22 to 25 are going not to be the good years. It's a down cycle, right? Just like, you know, I remember 2011, 2014, and then we had a massive upcycle, which I started seeing in 2017. But it really took a bite in 2019. It really went crazy. I feel that we're going to go through another upcycle very soon. We're almost bridging that part now. It has to do with some events. I think in May or June of 2026, we'll get a new Federal Reserve person that's going to lower interest rates, making capital more free to invest. And that'll expand our business exponentially, as well as I also see the sustainability effort is growing. And, you know, if you look at Vera from day one, when it issued like 10 million tons one year or something like that, and, you know, now it's going to issue hundreds of millions of tons this year, let's just say, right? But it's down from its previous years. People go, oh, it's down. The best is yet to come. I believe we're going to have another big swing. My vote says it's going to start in the end of the third quarter to the beginning of the fourth quarter of 2026, where we're going to see a noticeable difference. And what I tell my team and what I tell most people who I work with is to position yourself to capitalize on that. Okay. So, you know, our market is cyclical. And it's 3 to 5 year spans. And we just go through another one. This is my third or fourth one. I don't even remember. But I do expect another upcycle, which will be very aggressive in 2028, better than it was in 2020 to 2021 to the beginning of 2022, right? And I see that happening really at the 28 to 30 cycle. And then after that, it'll do it again unless there's rules or laws changing. But right now, the market is a little confused. You know, are we going to do the airlines? Well, we got this, we got that. It's all nonsense noise. But once the market starts moving and capital starts flowing freely, that's when we ride that wave and we capitalize on it. But you have to be patient in business. And it's one of my biggest weaknesses. But if you can strategize yourself and position yourself, like I told Rene, let's start Velaterra in 24, 25, 26, right around there, because that's the down cycle right there. 23, 24, 25, let's do Velaterra, because we have to get it ready, because when it jumps back up, I want to capitalize on that, right? So my vote is prepare yourself, set the structure up so that when the market does come calling and buying credits take years to develop. But when the market changes, it could change in literally 6 to 8 months. So you have to be prepared. And the way to be prepared, you know, in your business is up to you. You have Neelesh there who could help you because he's seen a few big cycles. And the next one, I think, will be even bigger. And the products that will move and really be capitalized are blue carbon, removals, that kind of stuff, biochar, stuff like that. Providing that you guys are developers, you got to develop that project as efficiently as possible because there is some competition there right now. Right now, supply outweighs demand, and you need to have outlets like Pure Earth and whatever to help market your stuff. However, you have to operate in such an efficient manner that you can make as much profit margin as you possibly can when you develop this project and still be competitive in pricing. Anyway, I don't want to torture you guys too much longer. It's really
No,
nice
this
to
is
talk to
super
you guys.
helpful.
Thanks, Nick.
And
the world needs
I'll
to
let
hear
you
it,
guys
Nick. The
rock
world
and
needs
roll
to
and
Very
have a
hear it.
great
interesting.
time.
Very interesting cold intro. That was awesome. Thanks, Nick.
All right, guys.
Best.
Rock
Thanks,
and
Nick.
roll, man.
Appreciate it. Cheers.
See you later,
Thanks,
man.
Nick.
We should
Yes.
have like an opening thing that like a warning that says like this podcast was brought to you by Vintage 2008. 100%.
2008. Yes.
Welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside co-host Rene Velasquez. And we're
Back,
thrilled to
baby.
be joined today by the team from Equilibrium. We got Sri, we've got Sid. Thanks, guys, for joining us.
Thanks for
Don't
having
forget, we just had
us.
Neelesh. Just join us. Do a
And
cameo.
Neelesh was here. Unfortunately, he had to go, but you'll see that exchange with him and Nick earlier in the pod. But we've got Sid and Sri. How you guys doing?
Good. Just a very, very busy day, but excited to be chatting with you folks. We have some exciting things lined up, and yeah, hopefully we can get to chat about it through the conversation.
Yeah.
Looking forward to it.
Yeah, 100%. So I think to start out and to give our audience a bit of context, we would love to learn about Equilibrium's like founding story, what problem you guys set out to solve and how the team came together around the idea of smallholder-led carbon removal in India.
Absolutely. So just to give you a little bit of a background, right? Both Shri and me come from a finance background. I mean, I was in venture capital for 5 years. Shri spent some time doing investment banking, worked across impact investments, etc. Right? And when we were looking to solve the problem in the carbon space, we thought that the space needs more structured finance. It needs more pools of capital coming together towards people who really need the capital, right? From a climate resilience lens, from a climate adaptation lens, right? And that's when we stumbled upon carbon finance, and that's where we thought that our skill sets could be used effectively to channel more and more capital, right? And obviously, the first issue we encountered was the integrity issue in the market, because I think we were in 2022. Early to mid 2022, the biggest issues were around integrity. So we thought, okay, why don't we, layer some technology around the projects that are there, right? And see if, good quality MRV can really solve the integrity issue and can help understand, or rather can give us cues or leading indicators as to what are good quality projects and what are not so good quality projects, right? This was the time I think ratings agencies were also evolving in the market, right? And quite honestly, when we started putting our DMRV on certain projects, we quickly realized that tech alone cannot solve this problem, right? It needs to be effective project design. It needs to be effective project operations. It needs to be thought out almost like an infrastructure project, right? Where technology can play a role in enabling transparency and integrity, right? Which is when we started to layer and add, carbon science and effective carbon science. So essentially, if you look at the last 2.5 years, we started on the capital stack. We then moved down the technology pathway to help solve for integrity, because we thought that integrity is going to add more liquidity in the market. We thought technology alone would not solve that problem. So then we started building out a deeper carbon science team, with really good scientists coming on board. And along the journey, we realized operations is equally important, and which is when we got in Neelesh as well, right? Because he's been in the market for 15 years. He's issued the first credits in India for any nature-based project. He's traded 15 million credits. So we thought that, bringing in that experience and wisdom would help us become a good full stack carbon project developer. So quite honestly, the way we got and the journey that we have gotten to become a full stack carbon removal company today, right, is a function of where we saw the problems and how we could solve them effectively. And that's where we are as an organization today, a full stack carbon removal company working across multiple different pathways. If I have to categorize our business today, we have, a nature-based pathway through which we're doing carbon removals. And within nature-based pathway, we have three categories, which is regenerative agriculture, VM42 AWD. We have agroforestry, which is VM47. We have mangroves, which is VM33, right? And all of these fall under our nature-based pathway bucket. We then have what we call our engineered CDR business vertical, which is essentially the first pathway that we've been working on is a biochar-based pathway. Within biochar-based pathways, we're working across both registries, Puro and Isometric. And yeah, I mean, one of the things that we're seeing is there's another registry that's come, which is Rainbow. So we intend to work with all of the new age registries that are backing technology, and we're building, our projects in the engineered CDR space as well. The good thing is the biochar-based pathway also complements what we've done on the nature-based pathway really well. So, there we see some overlap. So within our engineered CDR vertical, we have biochar, and we have some things exciting coming up. We don't talk about it very publicly, but this is the first time I'm talking about it publicly. We have piloted our enhanced rock weathering project as well in coffee, and very excited to sort of start to scale it in the coming months. So yeah, I mean, essentially we are a full stack carbon removal across multiple different pathways. But the one thing that's binding all of these use cases is that we work with smallholder farmers. India is a land of smallholder farmers, and we have close to about 125 million farming households in the country, right? And a large part of them are smallholders who are most susceptible to climate change, right? These are folks that experience erratic rainfalls, folks who sort of experience change in soil patterns because of erratic rainfall patterns, and most importantly, are least equipped to solve the climate change crisis themselves, right? And that's truly what drives us and continues to motivate us, right? To solve for these individuals. I'll let Sri sort of add to this, and hopefully, the founding story comes together.
Yeah, I was going to ask you about your founding story, guys. Can you give us that kind of thesis? And then also, like, what was the spark that led to the founding? And then you kind of intimated it, but I really want to kind of double click on what you said around the problems that you were trying to solve. Can you sort of tell us a little bit about that?
No,
Yeah,
absolutely, right.
Yeah.
Yeah. I think fundamentally, when you think about it, right, like, and I want to dispel some myths also along the way, Rene, Eddie, when it comes to perception around smallholder farmers and like why it doesn't work, right? Like, I mean, at least that's the narrative that's kind of set. But I think the way we thought about the thesis will clarify some of the things, right? Like, firstly, I think both of us are very clear that if you need to kind of build credible pathways for climate capital to flow, you need to build on top of things that have already worked, right? And what has already worked is the voluntary carbon markets and the pipeline that it provided for you to like kind of move capital towards promising climate solutions on the ground. It worked with renewables, flattened the cost curves. Obviously, there were a lot of other aiding factors around regulations, around policy, incentives, around feed-in tariffs, and those sorts of things. And the carbon markets nicely complemented that, right? And I think you see that playing out in the nature-based solution space as well as the CDR space. Like, I think what we need to clearly understand is any sort of like conduit for capital to flow. Capital follows conviction, capital follows, confident regulations and those sorts of things. And it's a moving target, right? Like, and we saw.
But it also follows the demand signals, like strong demand signals. And I think that that's a tale of two cities right now, because CDR on the primary is driven in large part by a concentrated group of buyers. We all know their names, and they're pretty well capitalized businesses, and they're playing a very active role in this space. But outside of those folks, this nascent market around durable CDR, it does not have a secondary market, right? That's actively traded. And so there's no speculative activity in that space. And I'm curious about that. And then contrasting that to, let's say, nature-based, where we have seen speculation come in, but effectively now the demand side come out for the large part, maybe with the exception of certain pockets of high integrity ARR, for example, and some avoided deforestation on the sort of high ratings. How do you see that?
No, I think my thesis on that is fundamentally we're at a little bit of like the beginning of that transition, right? Like, because for you to have enough volumes in secondary, you need to have enough volumes in primary. And obviously it's a little bit of like, a situation where like, the market is wrapping its heads around what sort of like, how do you even like set up frameworks so that like, the supply that's coming on primary is sufficiently trusted, is sufficiently high quality. And I think like
I think that's the piece, right? I think you're absolutely right on that. I think it's the granularity of or the specificity is the right word, of the demand signal, right? Right now, those big buyers that are buying out on the forward curve, they're highly specific and targeted at a project specific level, and they don't necessarily have replacement alternatives, and how they view it is very much as an origination exercise. But as markets tend to mature and demand starts to follow those early leaders, now you start to get more of the liquidity providers taking on positions and starting to go long and build out that book to meet the oncoming demand. I think what we're all waiting for in this industry is that demand become realized, and it comes back down to the drivers. On the voluntary side, the incentives are not yet clear still around, or sticky enough. I think they're clear, but they're not yet sticky enough. On the voluntary side, they can emerge and then retreat fairly quickly. It's that engagement or intersection with compliance markets that really ends up driving that stickiness, right? And I think we're seeing that. But conversely, compliance markets tend to be not necessarily so driven towards integrity, right? It's the lowest cost to operate or lowest cost to source.
Yeah, but Rene, I have a view on that. I have a view on that, right?
Yeah.
I think I was talking to Ed about this, right? One of the big trends that we are seeing this year is for profitization of the registries, right? If you look at Isometric, Puro, Rainbow, these are at some level, venture capital / external capital funded companies, right? Which to an extent are obviously rent seeking and profit seeking, which is not a bad thing, by the way. That
no,
leads,
of course not if they add value.
Absolutely,
they do. And they challenge the status quo, and they engage in innovative approaches that have helped to disrupt the market for the better. So I'm a big advocate of that. Otherwise, we had a duopoly that was kind of stagnant, and now we're seeing much more innovation coming out of Vera, certainly, and Gold Sand to a lesser extent. On a methodological side, sure, registry. Yeah, they do.
Free markets reward innovation. Free markets pushes everyone to innovate, and as long as everyone knows that they're moving towards the right sort of pathway, I think it's a great thing, right? But what I was saying in the context of integrating voluntary and compliance, right? One is we're seeing registries. Second, we're also seeing a lot of these rating agencies come up, right? I mean, they've been there for 2-3 years, but I think truly they've started to make a mark now, right?
About 5, yeah.
And all of them are absolutely creating value to the market. But what I truly believe is if we have to scale this market and make the pie bigger, right? When you go from voluntary to compliance, some amount of liability or some amount of responsibility, like I would like to call it, needs to be borne by these registries and by these rating agencies to ensure integrity when there is bridging between voluntary and compliance.
Yeah,
the insurance
100%.
companies doing the insurance. I don't think it's a domain or the purview for the standards. I'll take the other side of that argument. I think it's a straw man. I think that the standards right now, their job is certifying outcomes, right? And so then the rating agencies provide an opinion. I don't think you can insure against both of those. There is
I'm not talking
revocation
about
risk.
insurance.
So let me finish. I think there is like you can insure against revocation risk, and that's where buffer pools come in. But I'm going to go on a limb here, and I know this is not the conversation for today, but I do want to invite insurance folks on this podcast to discuss this, which is a wholesale rethinking of buffer pools instead of being managed at the standard and acting as a levy that is effectively applied on a project developer to withhold a certain like buffer, that insurance companies be that buyer of first resort by providing an immediate liquidity injection to the project developers that need it right up front, and then be able to price that through their actuarials and actually be able to write insurance policies against that buffer. They are much more adequately or accurately positioned than the standard. So I think there will be sort of a realignment in the space.
Yeah, I absolutely agree with you, right? Like I think what the buffer pool mechanism, I don't know at what point of time it worked, because fundamentally I think it's such a first level solution to such a complex problem. Because I understand there are uncertainties around quantification and things like that. I know what worked in renewables will not work in nature, because nature, your soil, your trees are living, breathing organisms. Obviously, I think it's like a single brush stroke to kind of, what is perceived as like a risk management tool, but ultimately it affects liquidity in the market, right? And I think there needs to be like the next level of evolution that needs to come.
I think that's the next domino to fall in terms of evolution. I think so. So to kind of, Sid, coming back to your earlier comments, right, around innovation is rewarded by the free market. I think that's the next piece. So the first wave is this kind of expansion around optionality, where we have different standards emerging and different registry providers, technology providers, exchanges, rating agencies. And that competition is driving innovation for the betterment of the market. There's inherent conflict and tension, and not everyone's rowing in the same direction, but ultimately the best ideas get rewarded in a meritocracy. That's the free market. And now I think this idea that is starting to gain traction around a wholesale rethinking of buffer pools and how we address those, especially like a systemic risk to the market, and then be able to adequately price that downside risk. And now back to what you guys began with, and now Sid, I want to double click on this. You talked about capital. But capital enters once you de-risk, right? Because they want risk management, because they can take for the upside, they can allocate capital for the upside, but the downside risk is what we can't protect against right now. So I'm going to hand you the ball back.
Sri, why don't you go ahead?
No, Sid, you're kind of keen to say something.
Yes.
No, I wanted to say just one thing to bring home the point of bridging voluntary and compliance, and I feel strongly about it, right? Which is why I think I want to share my idea, and obviously it's very open to feedback because it's just evolving as well as I speak, or rather as I think through this market, right? There has to be some sort of a fine or some sort of a liability that, let's say, a registry needs to take. Let's say if bad credits go into the compliance markets, right? Same way, like almost like how a ratings agency like Moody's or Fitch gets called out if bad ratings gets absorbed into the markets and things go south. I think they get called out. I feel like what needs to happen is, if we are integrating voluntary credits into compliance markets, I think the first level of credits that get integrated into compliance markets need to be the high integrity credits, which then means that whatever standards, whether it's AAA on Silvera or A in B0, like what is their internal threshold of what they believe is high quality credits, right? I think the first step to integrating voluntary and compliance is to bridge high quality credits, because at the end of the day, it's obviously the fiduciary responsibility of regulators to ensure there's only good quality going in. Like we can't be casual and say that, hey, let's let anything go in, right? And
no, but I don't think that's a risk, to be honest. Like I agree with you, but I think in practice, look, what should happen and what does happen is different in the real world, right? Because like nothing's in vitro, it's in situ. But I think it's happening when you see markets, and it's not voluntary compliance. I think the more apt is just, these are project-based approaches as opposed to sort of the cap and trade, right? So project-based, and now you have governments effectively electing to choose the project-based approaches and recognize the certification standards in their compliance systems. The Singapore system is one such example with this whitelist. And then you have Colombia, and you have the COAS in South Africa, and a number of other systems are looking towards that. And I think we see the evolution over time. I look at Corsia, as an example of a very deliberate process, I think a little bit atrophied, if I'm honest. We're doing some analysis right now for some clients in the aviation space, and we can see that market is critically undersupplied right now on the spot and potentially throughout phase one as a result of some of these bottlenecks, insistence on corresponding adjustments as a integrity feature, slowed down by the pace at which governments are able to actually communicate their NDCs and then have the processes in place for LOAs and corresponding adjustments. So that's one issue. Insurance insistence at Corsia as well is slowing things down. The private sector is doing a good job, but again, there's a pool of very, very small pool of adequate supply right now on spot. And essentially airlines that feel like they're price takers and not price makers, right? And the demand is looming. So, but eventually we get through these design issues. It's just like any wave of technology, any wave of a market. The first few iterations of the product are not so great. You debug over time and you start to apply this positive screening to ultimately improve. And then I do think that you're right. I do think that the market transitions towards the higher end of the spectrum in terms of integrity. And I think the technology overlay provides that level of transparency. But we just have to move towards like a financial markets approach to carbon as an asset class, right? And this is kind of what I want to come back to, because you guys talked about your background coming in from capital markets, VC, etc. And I want to double click on that and understand really how you guys are talking. You mentioned capital stack numerous times. Eddie and I are in the trenches on a daily basis. We find ourselves having identified this gap in the market where developers are struggling to access financing. They may have an offtake from a large buyer, but they're actually trying now to bridge that financing gap. The buy side, we talked about primary markets, is not necessarily willing to cross that bridge and provide the at-risk capital. They're willing to provide an offtake, and that offtake then needs to be communicated as a de-risking event to folks on the cap side who can come in and provide equity, more risk on, and obviously very expensive form of finance, all the way down to debt level finance. But that's on a risk spectrum: higher risk, higher reward; lower risk, lower reward. And we're seeing this evolution, but it's the understanding at those investor levels, or the lack thereof, of carbon markets is one thing. Two, they can hardly price this asset class because there's no hedging instruments right now in the market. We've seen a retreat or an abandonment of my favorite futures contracts. I have vested interest in talking about my book because I launched them. But we effectively have a lack of hedging instruments, right? We have this emergence of insurance, but it's not yet mainstream. And these instruments, well, these tools or approaches are really critical for market to really to gain traction. I was listening to Eddie's episode with Melissa Lindsay from MSurge today, because I wasn't able to join that episode, and they talked about that, right? They talked about how we need now capital markets to really start to come back in. So anyway, I just want to hand it back to Eddie. Sorry, mate.
Yeah, well, actually, no, it's a good exchange that we've been having. But I do want to touch on something that Sid said, and I think he did touch on a core issue or challenge in the market. And in any other market, let's take securities, for example, financial securities, right? The stock market, the regulators is held accountable, right? If we go and buy a stock on Robinhood, or we go to Charles Schwab and we buy stocks off the NASDAQ exchange, we know that that's a legit company with fundamentals, and we can go and access their documents, and there's really no risk that it's BS firm or a BS business. In the carbon markets,
there's fiduciary obligations as well. Once you disclose on a public and you go public, there's certain regulatory requirements. So that's a good
one. But the point is, in the stock market, you could buy a stock and walk away without feeling like you need anything else. My point is, in the carbon market, buyers don't feel like they could just buy the credit and walk away and be done with it. Like, they need buying a credit issued by Vera, issued by Gold Standard, issued by whoever isn't enough. They need now, that's why ratings have come in and played a role, because they need other bars and measures of high integrity, high quality, and they need other certifications. But in any other market, buying the commodity from the standard is enough, because if it's issued from that standard, that means it's past the bar for integrity, for quality. And what happened with in the Red Plus market when a bunch of projects came under scrutiny is that the regulators, didn't take the accountability and push the accountability to the developers, and that killed the market. So there is, I think, I agree with what Sid said about the standards or registries being accountable.
But Eddie, I think
they have to be accountable.
Can I take the other side of that argument? Yes, they have to be accountable, but they don't have the balance sheet to be accountable. Right? Like Sid, you mentioned.
I don't think that's an excuse. I don't think that's an excuse.
No, it is, because regulators
you can't raise venture capital. You can't raise venture capital. By the way, I love all of the new age registries. Just a disclaimer, right? But you can't charge the kind of fees you're charging and not take any accountability or responsibility.
That's my. I'm just gonna add another layer.
Let's put the new guys to the side. Can I just counter this? And I love this. This is fun conversation and discussions here. But I'm going to stand up for Vera here. And I know people think that I bash Vera all the time, but I love Vera. And if I didn't, I wouldn't actually, challenge them.
We love Vera too.
But Vera's a dominant standard for a reason. The marketers appointed them as the dominant standard because they're the best out of the bunch, right?
No, they were the first. And I'm sorry to say they were the first or second.
They were not. Yeah. They were not. They were the second. Gold standard was the first. Yeah, exactly. Okay, but Vera was. It's just like the Goldilocks. I have a 5-year-old, so we read Goldilocks, and it was just right. It was just right. Not too hard, not too soft, not too hot, not too cold. But to Vera's point, right? And you talk about the rent seeking and profit motives of the new age standards, and their registry ecosystems. Great. Vera's, not. It doesn't have the backstop of a government, right? So we talk about financial regulators, and financial regulators can be held accountable and can hold people accountable, but they're backed by governments. In this case, this is a voluntary standard backed by scientists. They're not set up for that. So it's very difficult to and easy to call out on the T's and C's and say, oh, they weren't holding folks accountable. Look, lessons have been learned, but now we've got a regulator of sorts in the form of the ICVCM. I think the ICVCM now codifies the code of practice effectively for the programs, does so very well, holds them accountable, and has the governance framework for the methodologies, approving the methodologies, thereby making sure that all of these programs and their methodologies adhere to the core carbon principles. That's the litmus test, and that's the check, or the safety check for the market. Now, if a standard doesn't do right, now there's a risk that they get de-recognized or de-platformed by the ICVCM, and that will be deleterious to their business model. So now their feet are held to the fire. So I think that's the emergence of the regulatory kind of purview. And then you've got support by governments that are co-opting the private standards or the independent standard bodies, and that holds them accountable as well. And so it's just layers of network effect that integrate accountability. And hopefully now we start to see better balance sheet and fiscal management and prudence at what were or still are NGOs and haven't been that well managed.
Yeah. Okay. I want to move on. We're moving on.
Let's move on.
One last point there, right?
These guys are like bulldogs. I love it.
Yeah. The one thing that I'm super happy about this year is, for the first time in the last 3 years, I was asked, how was our registry experience, right? And we were evaluated, or rather we evaluated a registry based on the experience that they gave developers. As a founder in the space, it is so pleasing to hear that, the standards and the registries treat developers like how, software providers treat them as with customer experience, or any consumer product treats them with customer experience. Yep. We have to realize that the first generation of developers worked in a very constrained system. I'm really grateful for the fact that these new registries that have come, that make our lives easy and our technology first as well. And we need to give them credit for what they're trying to do to this market. And, I truly respect that innovation. And, I'm hoping that these registries over the course of the next half a decade will fundamentally help us, increase TAM and increase market size of what we're all trying to do, right? And Rene, just coming back to your question on how we're looking at financialization or assetization of this market, right? I can speak for myself. When I started this journey of, the carbon credit sort of deep end, right? there are signs of it being a commodity, there are signs of it being a security, right? And the challenge has been that, like you said, there hasn't been enough certainty in the market, which is why liquidity hasn't followed that much, right? Fact of the matter is, carbon is still a 20-year-old, let's call it asset or commodity, right? And every
30,
commodity,
30, 30, 30.
30-year-old, sorry. I know you corrected me,
I
the
talked to
other
Mark
day.
Stewart this morning, who's the chairman at Vera, right? We talked on some stuff around his business, allotrope. So he's one of the OGs, like the original.
Yeah. So 30-year-old market, right? Every market went through its ups and downs. You look at gold, you look at steel, you look at oil, right? Were there good faith actors? Were there bad faith actors? Absolutely. Did the markets correct themselves and sort of align towards almost taking the Darwinian theory, survival of the fittest, to survival of the most integrity oriented players? Absolutely, right? This is exactly how the market evolved for basic commodities or basic products that we use today. And if you look at carbon, we think if we take a 30, like probably the next 30-year lens, it's going through its ups and downs, and eventually there will be that quote unquote equilibrium where there is going to be
Nicely done.
benchmarks that are set for what are good quality avoidance credits, what are good quality biochar based removal or nature based credits, and what are good quality innovative CDR methods that are going to come. And I think it's almost like steel gets valued as SS302, SS304, SSXYZ, right, based on quality parameters. I think the carbon markets themselves are going to see that. And for different financial providers to take capital risk, some sort of certainty needs to come in the market, right? And obviously we are seeing that with offtakes from large institutes like Microsoft, Google, Stripe, Frontier, etc., that they're trying to bring some amount of pricing risk mitigation by giving these large offtakes. And I think innovative financial institutions are coming and saying, on the back of these offtakes, we're willing to take some amount of risk. Obviously, does the cost of capital continue to be in late teens, mid-teens for these kind of risky projects? Absolutely, it's fine, right? Which is where we think that commercial capital will continue to play in the mid-teens to late teens in this category. This is where it played in the renewable energy era in, let's say, late 2000s and early 2010s. You've seen that transition where in the initial days the cost of capital was expensive, but as and when certainty of delivery, certainty of demand came through, the cost of capital for clean energy transition came down. And I think part of the responsibility that we all have is to bring that bankability and predictability for carbon, so that financial institutes start to reduce cost of capital. That's one. For now, how we have gone about doing it is we view the capital stack as an inverted pyramid, where at the bottom of the inverted pyramid, you start off with like impact capital. Over and impact capital includes philanthropic capital, grant capital, outcome-based financing at cheaper interest rates, right? That's where the impact capital stack comes. Then you have your carbon financiers, right? You have almost, I think now 6 to 8 institutions that are willing to do just pre-financing, project financing. That's the next layer. Over and above that, you have your equity financiers that are willing to sort of give you that, capital risk that you need to put as a developer into your projects as well, right? And over and above that, you start to see private equity or, other sort of growth equity investors that see that this asset class is emerging and are willing to put in some risk, where they see that they could get to like a 4-5x outcome in a 3 to 4 year period, right? So the capital stack itself will continue to evolve as and when the maturity of the market starts to play out. And I think the offtakes and taking away the pricing risk, it's a good starting point to get different financiers. But for now, what we have done is, we're trying to execute blended finance transactions. I'll let Sri sort of talk a little bit more about that. And, we did one of India's first blended finance transactions as well. And Sri, you can chat about it.
Yeah.
Yeah.
I have a question
Sorry,
for
Ed.
Sri. Yeah. Just to set it up, because I did want to move on to talk more about like project bankability and like your portfolio, right? Because Equilibrium, you mentioned you guys have a wide portfolio: enhanced rock weathering, biochar, agroforestry, mangrove restoration. I mean, that's a very unique mix that not many project developers have in their portfolio. That's so how do you approach, what have you seen with regards to project bankability and financing across those different project types? And then also, what's your approach to like MRV, digital MRV, and scale? How do you balance the different types of projects that you're working with?
Yeah, yeah. No, I'll brief my answer into that, but I want to pick up on something Sid said, right? The capital stack that we're talking about, and I think it's going to link back to your question as well, Ed. It's something that we had to put together out of necessity, right? Like when you fundamentally think about it, what are the types of risks that developers are contending with today, which shouldn't be the case in a slightly more mature market, but our reality is in front of us, and there's nothing that we can change about that. Obviously, it's an evolving market, but we're dealing with pricing risk. We are dealing with issuance risk. We are dealing with delivery risk, and there are like a bunch of these things that we're contending with, right? And if we have
Counterparty risk.
break that counterparty risk, and like, I mean, obviously the list goes on, right?
Mhm.
And when we have to fundamentally break it down and say, like, what is that one thing that we can stitch together and move the needle on project by project? Like, we started like around early 2022. Obviously, I think like when we needed to follow the demand, right? Like naturally, I think regenerative agriculture was quite hot then, like, and then like there were certain complexities around the methodology. It went down, it came back up, and like there were a bunch of things that was going on with each methodology. And I think there is a little bit of a flavor of the season type of connotation to like different categories and different methodologies. We started out with Region Ag. We had like a very clear thesis on why that would work, because the smallholder farmer thesis that we spoke about, India, contrary to what a lot of people think, like, I mean, like it is the smallholder farmer ecosystem, it's the density of smallholder farmers is what lends like operational leverage for us, right? Like, I mean, it's not like very, I mean, while lands are fragmented, it is still like kind of like very, very concentrated. So if we picked one district, we were going to get like a bunch of like smallholder farmers and the area that we were going after. So that was one of the reasons why we picked that. And there were obviously certain considerations around cash flow cycles, because like time to generate credits, assuming everything is good from a design point of view, from a registry progress point of view, you'll get your credits in like 12 to 18 months. We obviously were trying to solve for that when we started out, and the demand signals kind of dipped and like it became a little weak, and naturally like we had to pivot and like adapt and evolve, right? That's when like agroforestry was the project category that we were really interested in, because VM47 as a methodology is a little bit future proof, right? Like, I mean, it was integrating the right sort of elements around remote sensing, geospatial data, integrating performance benchmarks. It had the right kind of rigor when it comes to accounting, carbon accounting, as well as like, certain things that we could do as a business that others couldn't potentially do. So we added that to our portfolio. And then naturally, when we kind of evolved as an organization and built our teams out, we realized there were quite a bit of like, operational leverage that we can build from the kind of people that were looking at like some of the elements in these two projects and how complementary certain categories like biochar sat, right? Like, I mean, when you fundamentally think about it, it is the accounting part of it is like fairly like transferable, right? Like the carbon accounting part of it, the technology part of it. But all of these things cannot happen without the capital stack, right? Like, I mean, we can add projects to our portfolio, we can add categories to our portfolio, but fundamentally what moves the needle on the ground is the capital stack. So when the demand side kind of like, cooled off when it came to VM42 or regenerative agriculture, that's when we decided to look at like, impact capital a bit more seriously, right? Like, and I think that's where our USA transaction kind of like lended a lot more, like rigor and accountability to the way we set up our project systems. And that was actually the first transaction that like we've managed to stitch together from a blended finance point of view. Because what does the capital that can take a bit more risks than like your typical conventional common capital, if that even exists as a category, can do, right? Like, I think what they can do is try and prioritize impact, try and blend sort of like, everything that they are used to, right? Like, I mean, when it comes to philanthropic capital, there is a lot of like attention given towards inputs, some attention given towards outputs. Obviously, that entire category of capital has gone through its own transformation and like, a little bit of like, move towards lending more accountability, and that's where like outcomes-based financing and those sorts of instruments have come in. But what we managed to bring to the table with our design was, hey, you put in, say, like $250,000 into the project today, right? But what that will unlock is an 18x sort of like a pathway for private capital or carbon capital to come in. And we showed them a very clear pathway as to like, what this money is going to do today and how it's going to be set up. Obviously, it was a bit of a gamble for them because like, not many people have done it before, right? But I think we could draw on the sort of like considerations around like existing blended finance structures that have worked, how people have blended concessionary capital, but where they struggled with is the pathway to bringing in mainstream private capital, right? Like, and I think that's where we came in and solved that problem. And carbon markets is a great example for that. Obviously, like skeptics are going to be like doubtful when it comes to like whether it'll work or not. But, if you're delivering on the impact outcomes, the cherry on the cake is if you're able to bring in like private capital, right? Like at this point of time, even like a potential for them for any sort of like recipient or grant recipient to bring in private capital is promising enough for like some of these people to take the bet. I'm not saying everybody is at that point, but at least like, I mean, like it's also about like the kind of team that is working on it, the kind of people that are kind of positioning this. And I think that's where like some of our experiences as the founding team and the team that we've put together came in a little handy. So I wouldn't say it's accessible for everybody, but at the same time, it's not inaccessible if you kind of like have the right building blocks, right? So that's one category.
Yeah. Rene, thank you for that.
He's been holding his hand for a long time.
Yeah.
I just found this feature on Zoom. I don't use Zoom very often, but I raised my hand. Yeah, no, interesting conversation here, guys. I just wanted to provide sort of some insights or perspectives from my side as a counter. So, Sid, and Sri, I appreciate the capital stack discussion, but I'm not sure whether the metaphor of a pyramid is the most apt. I just because I think it's not proportional. And so like I think maybe a metaphor that we should consider in an apt metaphor would be like a forest. Think of it like a forest ecosystem. And I think carbon markets are very much like a forest ecosystem, and there's a pun intended there, where essentially you've got, and taking your stack, and I wrote notes down, essentially you mentioned sort of the seed funding, the grant funding, that concessional finance essentially is kind of like the organic matter effectively at the forest floor, essentially, right? It's like that, philanthropic and public funding help projects to go from concept or idea notes to feasibility study. But then we need a thriving and vibrant venture capital ecosystem and angel ecosystem to help that catalytic capital. And that, so as essentially early equity, and think of that as the understory. So like when we've got clients doing reforestation projects, they always worry about those early sort of growing plants to create the understory for the shrubs, etc., saplings for the bigger trees to then be able to grow, right? And I think VC needs to come in to fill that gap, but we don't yet have it. And then you've got this broader sort of canopy, right? The bigger capital into town coming in and writing bigger tickets. And you guys use the term private equity, that's fine. But I think there are specialized funds who can come in and provide and write those tickets, and they're looking for risk. They're risk averse, right? But they're looking for projects that have been de-risked at certain events, and they're still willing to make some bets. But they're looking for ticket sizes that are typically very large. We talked to one investor the other day. They're looking for 15 to 20 million checks. That's the type of checks that they write. And most projects, I think it's fair to say, would be much smaller in terms of the quotient. And then as we go up, up above the canopy, like you need the sunlight and the rain, and that's the institutional capital. And then eventually, as projects mature, they start to spin out cash, right? So it's the carbon credit revenue, and that's where you can start to get more of that impact, around, well, not impact, but more investment coming in from the debt financing side, right? Because it's more institutional, it's more infrastructure based. And so we had Chris Leeds come in and on the podcast a few weeks back before he went to COP, and he was talking about that, right? The perspective of the financial institutions and their ability to invest and their willingness to invest, but it's throttled by financial investment decisions. So I would first postulate this metaphor, and it's an imperfect one, but essentially, now I want to bring it back to reality, right? So here in Singapore, we have a very vibrant ecosystem, and we see elements of this kind of capital stack, as you mentioned. Temasek Trust is building out essentially a philanthropic component here, and there are other philanthropic bodies, whether multilateral banks and others. But that's one sort of example, and there are plenty of foundations and other folks that are writing grants. But then they're not discombobulated. They're not necessarily coherent in one sort of push in the same direction. We don't have a Y Combinator equivalent in the industry, right? That's a lack, and VCs have turned away completely from carbon. It's just not attractive to them, and so we don't have many folks funding projects and or startups in this space at the seed or Series A rounds. But then we do have the Gen Zeros of the world and other large institutional investors that do come in at a Series B check. So there's 20, 30, 50 million, depending on market cap, right? And so there's this gap in the middle, right? And we talked about how innovation is rewarded and is the driving engine of the market. Right now, a lot of folks are trading water, right? Quite frankly, in the project development space. And so you guys claim to solve that problem. I want to know how you guys access that venture capital. So it's a long diatribe, but to come to a question, how did you guys access that venture capital pool? And how do you actually then deliver the returns to them to encourage them to want to come back?
Yeah, Sri, I'll take that, and then possibly
you got to take that. I raised my hand at a very different point, and Rene just did like one solid U-turn towards the end. So I got to dive back.
I'm trying to meander, man. I'm trying to keep you guys
we'll come back. We'll come back to that. Yeah.
Look, the premise for venture capital is very clear, right? I look at the carbon industry very much like the renewable energy or the clean transition industry, clean transportation industry, right? But for a minute, just for the sake of explanation, let's look at it as renewable energy, right? Renewable energy had offtakes, renewable energy had PPAs, and developers sort of delivered on those PPAs. Developers then got more offtakes. Developers raised finance. Developers created value to different stakeholders and ended up creating shareholder value along the journey. Now take that parallel to the carbon removal industry. Developers like us are very early in that journey. We need some bridge financing to show some skin in the game to attract more sort of 5 million tickets, 10 million tickets in the market. We're telling them that, hey, we'll put in the first 300K off our balance sheet, the first sort of 500K off our balance sheet. Can you come over and above that, which is essentially skin in the game? And eventually we are creating these 5 million, 10 million type assets, right? That will start to churn out credits on a yearly basis. And at some point, we believe that we can reach the late teens percentage IRRs for different financial institutions and make it a bankable asset class for more financial institutions to come and play this category, right? And every new industry goes through this transformation where the initial stages, there is some amount of risk capital that goes in to prove out the bankability. And that was the story that we told our equity shareholders, and they completely understood that if carbon is going to be a mainstream commodity or a mainstream sort of asset that is going to start to get valued by different institutions and different governments across the world, then project developers that are delivering on the back of that asset will continue to generate value and create shareholder value. And that's the story that we told our equity investors, and they were comfortable to obviously take this risk with us because we told them that we are taking an institutionalized approach to carbon project development. And institutionalized means that we're adding layers of technology, we're building out the best science teams, and we are innovating on the capital stack to continue to bring more and more capital. And I think that was the story that attracted our early shareholders, and they are seeing the kind of momentum that we could offer from a venture capital perspective as well, because in the next 2-3 years, if we continue to deliver on the promise, I think we'll start to look like a company that can deliver on the promise of venture capital. Is it a 100x outcome right away? Probably not. But if you can look at a 10-year horizon, and like we talked about certain trends like the integration of voluntary and compliance markets, this market can go from, I truly estimate that today the voluntary/verified carbon markets at about $10 billion, $12 billion in TAM, including the forward offtakes that are there. And if we integrate the voluntary and the compliance markets, I think we'll and if we do it the right way over the next 10 years, we should be looking at at a conservative scenario $50 billion of value to be created. And in a bull case scenario, somewhere around 75 to $80 billion. So, I mean, even if you take, let's say, 10, I mean, 10%, maybe it's not going to be one person, but let's say even if you take 1% of that value capture, there's enough of a revenue pool to build a large enterprise. And that's the promise with which we hope that, some of these macro factors, align and yeah, create like a very large, hopefully multi-bagger outcome for our early stage venture capital investors.
Yeah.
Interesting.
Sri, did you want to comment, or can we move on to another topic?
I'd just like to add one more detail, and I think it ties back to what Rene was saying earlier, right? I think what is essential to understand here is the kind of like, monumental effort that like suppliers need to put together for this market to move forward is something that like doesn't get talked about enough, right? Because the multi-bagger outcome that we're talking about, I don't think it's going to come through like a lot of distributed sort of like supply. I mean, like, sure, there needs to be like enough supply, but at the same time, the kind of like how the market is set up today, the kind of like, your regulatory standards, the risk management that needs to be done, the innovation on the capital stack, the kind of burden of proof on technology, because carbon projects are fundamentally data projects, right? I'm not entirely sure if it's accessible to a lot of people, and which means the ones that are in the market and are building towards these large scale outcomes, especially backed by venture. I think the kind of innovation and multifold innovation that needs to happen on every touch point that is there and in the project development journey, in the capitalization the journey, in the technology journey is so high that the stuff that you were talking about, right? Like Rene, about how, the likes of Temasek and like there are other few philanthropic foundations that are looking at it, but they're not pulling in the same direction, which means these developers or developers such as ourselves needs to kind of rein them in and show them the path, right? Like, I mean, like this is the right sort of like approach that you need to take for you to be able to solve that.
I think the philanthropy is like, it's a limited pool of capital, right?
That's one example. But I'll give you another one.
Profit
right?
seeking. They're distributing profits from from the founders, etc. But
exactly.
But they're catalytic. Absolutely. And I think that their role is as a catalyst. So I think that they're best placed for the feasibility work to help to catalyze, let's say, an industry. So if you have a roadmap and you say, hey, we want to see more of these types of projects in this region, let's create an incentive to help to create, and grow as many flowers and let them bloom. But then you need to have a follow-on ecosystem of VC that wants to take on that equity risk, like you guys mentioned.
That's exactly my point, Rene. I don't think.
But then, I think we're lying. I'm just trying to crystallize it. But then the other cool thing, or the thing that we need, is sophistication. We've had a really interesting conversation, but it shows that you guys come from a financial markets background and have that level of sophistication. I think it's fair to say that most project developers come from a nature-based and like ecological background, let's just say, for the nature-based folks, and they're not necessarily coming with a level of sophistication to speak the language of investors. And so there's this talking at each other kind of impasse, and we don't actually get the great unlock. And I think what we need to see is more sophisticated players coming into this market with stronger balance sheets to begin with. And you mentioned this, Sid, where you guys put on skin in the game. That's been lacking to a certain extent. And there's already some really great examples of firms that have already navigated this paradigm. And then you start to see the inevitable consolidation of these smaller players being eaten up and effectively being ingested into a larger platform and play. And that's when you start to see better risk distribution and allocation of that effectively moving away from a concentration risk on a standard or a methodology or a country, sovereign risk, et cetera, and now distributing it across and having carbon as that asset class across multiple jurisdictions and different markets. So you could have projects in the COAS, in Colombia, and in Indonesia, and Vietnam, and and hit a bunch of different touch points. And then it's also one counterparty. I mean, you have to have this one relationship with a large buyer, and then you could provide an offtake solution to them, and they don't have to do multiple onboardings. And so
Rene,
you start to just basically roll things up.
That's
cool.
Exactly our vision one day. Like you hit the nail in the coffin. Like that's exactly what we want to do and how we want to be.
Not on the coffin, man.
Head to the nail on it.
All right, let's move on to our last section. I mean, what would you say to like buyers that are still sitting on the sidelines, you know, that are unsure about the market, or, you know, what do you think? It's a good.
It's a good question. Look, I think to buyers who are sitting on the sidelines, if you have budgets, if you're in a high gross margin industry, please do support a market that's growing. Compliance is going to come someday, but if you could act before compliance, I think it'll catalyze a large market. And yeah, especially in countries that you're operating in, or if you have supply chains in countries that you could contribute through the voluntary carbon markets, I think you're effectively catalyzing change over the next sort of 20, 30 years. This market's
Do-
anyway going to come. And if you can
Mhm.
move faster, I think it's just going to help solve the crisis much faster. And hopefully we don't reach a state of absolute catastrophe, and some of your capital can help us sort of mitigate some of those potential disasters that we could see as a generation.
Yeah, and would you also, I mean, um, there's also a certain level of risk to corporates that kind of delay action, right? Or to a certain extent, there is transition risk. Like there is capital at risk in the long term coming from regulation, coming from policy, coming from compliance. So do you think that early movers do have an advantage, like participating early on and getting a sense of the market? Like, do you believe that to
Yeah,
be?
I think they'll know what to buy, whom to buy, whom to buy from, and how do they want to construct their portfolio in the most effective manner from an environmental perspective, from a social perspective, and from an economic perspective as well. So I think the early movers who start to like understand the market and start to purchase will be more well informed when compliance comes. Otherwise, a lot of people will end up scrounging, and they won't really spend their dollars in the most effective manner for themselves and for the communities that they're serving. So that is what I see today being the most value add in terms of
Yeah,
them starting off.
Yeah, I
sure
want
you
to
do.
add to that, right? If
Yeah,
yeah, so if you're waiting for somebody else to build the playbook, it's a playbook that they're building for themselves, which means you got to dip your feet in the water and figure out what your playbook is, take small bets, get some liquidity into the market, because everything that we just said about how, the cost of an action today is going to be so high that you might as well like take like your little like bullets before cannons type of approach, right? Like you just shoot some bullets before you shoot your cannons later. I think that's what I would tell to buyers on the sidelines today.
yeah. Well said, guys. I think, this has been a fantastic deep dive. We've covered a lot of ground. You guys, it was a great conversation.
Really enjoyed it.
Yeah, I want to thank you guys for joining us and, sharing some insights about, your views on the market and your projects in general. So it's been a real pleasure. And yeah, we want to thank our audience as well for tuning in to This Week in Carbon, and catch you next week. All right.
Thanks.
Thanks,
All
Ed.
right.